29.88 lakh crore. That is how much money moved through UPI in India in July 2026 alone. We scan a QR code, pay the cab driver, buy groceries, split dinner, no fee, no second thought. But Parliament has now changed a law that could allow a charge on some UPI merchant payments in the future. Before you panic, this does not mean your next UPI payment will suddenly cost money. But it raises a real question. If UPI is free for you, who is paying to keep it running? UPI isn't a problem because it failed. It is a problem because it worked at a scale nobody expected. And now someone has to pay for that success. Banks, taxpayers, big businesses, or eventually us. First, let's clear the heavy jargon. MDR means merchant discount rate. It is a small fee paid by a business when it accepts a digital payment. Say you use a credit card to pay 1,000 rupees at a store. The shop may not receive the full 1,000 rupees. A small part goes to the bank, the card network, and the company that processes the payment. That money helps pay for the invisible work behind a digital payment. Bank systems, fraud checks, customer support, settlement and dispute handling. On a normal UPI payment made directly from your bank account, merchants have had to pay zero MDR since January 2020. So the customer pays no fees at all. The small shop pays no fees at all. But the payment still has a cost. This is the part people often miss. A UPI transaction is free at the point of use, but it is not free to operate. Every payment needs bank servers, network capacity, fraud controls, settlement, customer support, and systems that work at an enormous scale. In July alone, UPI handled 23.66 billion payments. That is roughly 760 million payments a day. For years, banks, NPCI, National Payments Corporation of India, think of it as UPI's backend, and payment companies have absorbed much of this cost. The government has also stepped in. And where does the government's money come from? The exchequer, the public budget. In simple terms, part of the cost of keeping low-value UPI merchant payments free is paid with government money raised through taxes and government borrowing. For financial year 26-27, the union budget has set aside 2,000 crores for the scheme that promotes low-value Bhim UPI merchant payments and RuPay debit card payments. That money is paid as an incentive to support banks and payment providers that process eligible payments without charging customers or small merchants. This was a deliberate policy choice. It helped UPI spread from cities to tea stalls, kirana shops, small street vendors. But the Parliamentary Standing Committee on Finance found there was a significant gap they needed to fill. It said the 2,000 crore incentive covers only around 11% of estimated industry cost. The actual figure that the payment industry estimates to keep UPI and RuPay running without MDR is around 20,700 crore rupees a year. So free UPI is not actually free. The cost is being shared, partly by taxpayers through the budget and partly by banks, NPCI and payment companies. Why did one law change create so much panic? Because for 6 years, we have been used to paying zero. And zero is powerful. It becomes an expectation. So when people hear MDR and think, will I have to pay every time I scan a QR code now? That fear is understandable. Once something becomes a part of daily life, even a small change feels like a loss. But we need to separate two different things. A charge on a large retailer, an e-commerce platform, or a high-value business payment is not the same thing as charging a person for a 200 rupee payment at a local store. The whole policy fight will be about that line. Can the government fund the system without asking ordinary users and small merchants to pay for it? Here is a fact most people miss. A version of MDR already exists inside UPI. Say for instance, if you pay a merchant using a RuPay credit card linked to UPI, the merchant may pay an MDR. For small merchants, that fee generally does not apply on payments to 2000 rupees, but it can apply above that. Larger merchants can face MDR even on smaller payments. You, the customer, do not normally pay that fee directly. But unlike an ordinary UPI payment from your bank account, this is a credit card transaction. So it runs on a commercial fee model. That is why UPI is not just one kind of payment. Bank account UPI remains zero MDR. Credit card on UPI works differently. And that is broadly what people mean when they discuss a tiered MDR model, protecting ordinary payments in small merchants while charging selected commercial transactions alone. India is not alone in building instant payments. Brazil has Pix, the US has FedNow. Their models are different, but the basic point is simple. A payment system can be fast, cheap, and widely used without every business payment being free. Pix is generally free for people, but businesses can be charged. FedNow charges banks a small fee per transfer. India does not need to copy either of the countries, but it does have to solve the same problem. How do you keep UPI free and simple for ordinary users while making sure that the system can pay for itself? Now coming to the investor angle. Why are Paytm and Pine Labs being discussed? Both have large merchant networks and sell payment services such as QR codes, sound boxes, and terminals. If MDR is eventually permitted on selected UPI merchant payments, they could receive part of that revenue pool. And that is why the stocks reacted to the proposal. But this is not a stock recommendation. MDR has not been officially introduced. The rate, the merchant threshold, eligible transactions, and the share going to banks, networks, and payment firms are all still unknown. Broker estimates are only scenarios and there are no guarantees. Bernstein estimates that in one scenario, a 5 basis point net take rate could lift Paytm's financial year 28 profit before tax by about 27%. Jeffrey sees potential gains for both Paytm and Pine Labs, depending on what the final rules are. So the key thing to watch is the government notification, not the headline alone. In the end, 4 questions matter. First, who counts as a large merchant? Will this be based on turnover, transaction value, or both? Second, what is the rate? Reports have mentioned possible ranges, but until the government issues a notification, nothing is final. Third, can merchants pass it on? A policy designed to charge large businesses fails if those businesses quietly add this to everyone's bill. And fourth, where does the MDR money go? If MDR comes back, does it strengthen fraud control, bank systems, rural connectivity, and payment infrastructure? Or does it simply become another fee? That is the real test. A good MDR policy should keep everyday UPI simple and free, protect small merchants, and make the largest commercial users pay their fair share without making free UPI a cost that is simply pushed onto the government's budget. UPI changed the way India pays. If its first decade was about access, its next decade is about sustainability, keeping that network fast, safe, and reliable as it grows. Because free is never really free. And the question is, who pays for it? Subscribe to Decoder for more stories behind India's biggest money decisions and tell us, should large merchants pay a small UPI fee? And I'll see you in the next.